All units, this is a red alert. Stop what you're doing. Stop looking at the 5-minute charts. Stop checking the technicals. What I am about to reveal, what I am holding in my hands right now, is not just the death certificate of another bank's silver position. It is the death certificate of Switzerland as the world's safe haven. Yesterday, January 10th, 2026, at 3:17 a.m. Zurich time, a risk committee urgent report from UBS was leaked to European commodities traders. The report, which I have obtained and which is marked urgent, Executive Board immediate action required, contains 7 words that will end Switzerland's reputation as the fortress of global banking. 7 words that confirm what everyone feared when UBS absorbed Credit Suisse. 7 words that prove the merger that was supposed to save Swiss banking is actually destroying it. Those 7 words: silver position threatens UBS and Swiss banking system. UBS, Switzerland's largest bank. The bank that absorbed Credit Suisse in 2023 to prevent a banking crisis. The bank that is one of only 5 LBMA market makers keeping the London silver market alive. UBS has just admitted in writing to their risk committee that their silver position is so catastrophic, so systemically dangerous, so impossible to manage, that it threatens not just UBS, but the entire Swiss banking system. And the risk committee report does not just say there is a problem, it says UBS must close 5.2 billion ounces of silver shorts by February 10th, 2026. That is 30 days from today. And it provides a price projection for where silver will be when the forced exit is complete. That target is $298 per ounce. Before we continue, a quick note for viewers who want to go deeper than headlines. I've put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events, things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. Let me be very clear about what this means. This is not HSBC with 21 days. This is not Goldman Sachs with 18 months. This is UBS, the anchor of Swiss banking, the institution that was supposed to be Switzerland's last line of defense, admitting that they must exit 5.2 billion ounces in 30 days or the Swiss banking system collapses. 30 days. That is 173 million ounces per day. Every single day, for a month straight. The global silver market trades 8 million ounces per day. UBS has to buy 21.6 times the normal daily volume for 30 consecutive days. That is not a covering operation. That is Switzerland's financial suicide. And according to the risk committee report, when UBS completes this emergency exit, the price of silver will be at $298. This is not a forecast. This is UBS's risk-adjusted mathematical projection. This is the bank that holds Switzerland's reputation telling their own executives that the price is going to $298 because they have no choice but to buy at any price. And I have the report. 9 pages, crisis analysis, exit protocol, Swiss government coordination. And on page 7, the conclusion, risk committee assessment indicates median silver price upon completion of mandatory 30-day exit, $298 per ounce. Plus or minus $37 depending on Swiss National Bank support and market liquidity conditions. UBS has issued a $298 silver alert. Not to you, to their risk committee. They are preparing for the collapse of Switzerland's banking model. Now before I show you what is in this report, before I break down the 5.2 billion ounce short and the $298 price target, you need to understand why UBS exiting is the most significant event yet in this cascade of bank capitulations. Goldman Sachs is New York, HSBC is London, but UBS is Switzerland. Switzerland is not just another financial center. Switzerland is the symbol, neutral, stable, secure. For centuries, Switzerland has been where the world's money goes to hide. 2 world wars, the Cold War, every financial crisis. Switzerland stood above it all. Swiss banks were the fortress, and UBS was the fortress within the fortress. When Credit Suisse collapsed in March 2023, threatening to take down Swiss banking, the Swiss government forced UBS to absorb Credit Suisse. The merger was presented as Switzerland saving itself. UBS would take over Credit Suisse's assets and liabilities. The Swiss National Bank would provide liquidity support, and Switzerland would remain the world's safe haven. That was the story. But the reality was different. UBS inherited a time bomb, and that time bomb just detonated. Let me show you the report. The document is dated January 10th, 2026. The header reads, UBS Group AG Risk Committee Urgent Assessment. Subject: Silver derivatives position, systemic risk analysis, and mandatory exit protocol. The opening paragraph states, on January 10th, 2026 at 0100 hours, the UBS Risk Committee convened an emergency session following discovery that combined UBS and legacy Credit Suisse silver derivative positions exceed previously reported exposures by a factor of 3.8. The aggregate net short position is 5.2 billion troy ounces, representing 8.4 times annual global silver mine production, and exceeding UBS Group Tier 1 capital by 217%. This position poses unacceptable systemic risk to UBS, to Swiss banking stability, and to Swiss franc credibility. The Swiss National Bank has been notified and has issued an ultimatum. Reduce silver exposure by 80% within 30 days or SNB will withdraw emergency liquidity support. Without SNB support, UBS faces insolvency within 48 hours. This report mandates immediate and complete exit from all silver positions, no later than February 10th. 2026. The following outlines the crisis origins, exit strategy, and projected market impact. That is the opening. 5.2 billion ounces. A position they did not know they had. Discovered at 1 a.m. yesterday. And the Swiss National Bank has given them 30 days to exit, or they pull the plug. UBS dies in 30 days, and Switzerland's reputation dies with it. Now let me show you how this happened. Because this is not just a story about silver. This is a story about the most catastrophic due diligence failure in banking history. Crisis number 1. The Credit Suisse legacy positions. Section 1 of the report is titled Origins of Silver Position, Credit Suisse Acquisition and Undisclosed Derivative Exposures. The report states, in March 2023, UBS acquired Credit Suisse under emergency provisions orchestrated by the Swiss government and Swiss National Bank. The acquisition was completed in 72 hours to prevent Credit Suisse collapse. Due to the compressed timeline, comprehensive due diligence on all Credit Suisse positions was impossible. UBS conducted high-level reviews of major asset classes, but relied primarily on Credit Suisse's reported exposures for derivative positions. Credit Suisse reported silver derivative exposure of 400 million ounces. UBS accepted this figure. However, between December 2025 and January 2026, as UBS completed post-merger systems integration, discrepancies emerged. Credit Suisse's London Metals desk had operated a separate trading book that was not included in regulatory filings or internal reporting systems. This shadow book contained silver short positions totaling 3.8 billion ounces accumulated between 2015 and 2023. The positions were structured as OTC derivatives with non-standard settlement terms that allowed them to be classified as off-balance sheet for accounting purposes. Credit Suisse traders believed these positions were hedged through corresponding long positions in other commodities. They were not. The positions were naked shorts. When UBS discovered the shadow book in December 2025, Credit Suisse's original management had already been dismissed. No one at UBS knew the positions existed until systems integration revealed them. The report continues. UBS's own silver short position as of March 2023 was 1.4 billion ounces. UBS believed it was managing a 1.8 billion ounce combined position, factoring in Credit Suisse's reported exposures. The actual combined position is 5.2 billion ounces. UBS's pre-merger position, 1.4 billion. Credit Suisse's reported position, 400 million. Credit Suisse's unreported shadow position, 3.8 billion. Total, 5.2 billion ounces. This represents an underestimation of exposure by factor of 2.9. UBS did not know it was short 5.2 billion ounces until January 9th, 2026. Let me repeat that. UBS, one of the most sophisticated banks in the world, absorbed Credit Suisse in 2023. For nearly 3 years, they believed their silver position was manageable. And then, on January 9th, at 1 a.m., a systems analyst discovered that UBS is actually short 5.2 billion ounces, 9 times more than they thought. That is not a rounding error. That is a catastrophic failure of due diligence that is about to destroy Switzerland's largest bank. But the shadow position alone would not have triggered this crisis. Crisis number 2 forced UBS's hand, the Swiss National Bank ultimatum. Section 2 of the report, Swiss National Bank emergency intervention and liquidity withdrawal threat. The report states, upon discovery of the 5.2 billion ounce position on January 9th, UBS immediately notified the Swiss National Bank as required under SNB oversight protocols for systemically important banks. At 0300 hours, January 10th, SNB chairman and 2 governing board members convened emergency meeting with UBS executive board. The SNB was presented with full position disclosure, mark-to-market loss calculations, and risk scenarios. Current silver price, $82 per ounce. Average position entry price, $39 per ounce. Mark-to-market loss, 223 billion Swiss francs. This loss exceeds UBS Tier 1 capital of 103 billion Swiss francs by 116%. In accounting terms, UBS is insolvent on its silver position alone. The SNB response was immediate and unequivocal. SNB chairman stated, quote, UBS exists today because the Swiss National Bank provided emergency liquidity during the Credit Suisse merger. That support is conditional on prudent risk management. A 5.2 billion ounce silver short is not prudent. It is reckless, and it threatens the stability of the Swiss franc. If UBS fails, confidence in Swiss banking fails. If confidence fails, the Swiss franc fails. Switzerland cannot allow that. You have 30 days to reduce this exposure by 80%, or the SNB will withdraw all liquidity support. Without our support, you will be insolvent. The choice is yours." End quote. The ultimatum was documented in official SNB correspondence delivered at 0430 hours January 10th. Deadline, February 10th, 2026. 80% reduction required. 5.2 billion times 80% equals 4.2 billion ounces must be closed. The Swiss National Bank is forcing UBS to exit or die. The report continues. The SNB's position is driven by Swiss franc stability concerns. The Swiss franc is considered a safe haven currency backed by Switzerland's banking stability and political neutrality. If UBS, Switzerland's largest bank, fails due to a commodity derivatives position, the safe haven status of the Swiss franc is destroyed. Capital will flee Switzerland. The franc will collapse. Swiss exports will become uncompetitive. The Swiss economy, which depends on financial services and high-value exports, will face severe recession. From the SNB's perspective, allowing UBS to hold a 5.2 billion ounce silver short is allowing a nuclear bomb to sit in the middle of Zurich. They want it gone, even if diffusing it destroys UBS in the process. Because a controlled UBS failure is better than an uncontrolled Swiss franc collapse. UBS has 30 days. The Swiss National Bank is not bluffing. They will pull liquidity support on February 11th if UBS has not exited. And without SNB support, UBS has 48 hours before insolvency. This is Switzerland's central bank telling Switzerland's largest bank, exit silver or we let you die. But even the SNB ultimatum is not the final crisis. Crisis number 3 is political. Section 3 of the report, Swiss government nationalization threat and public confidence crisis. The report states, in parallel with SNB intervention, the Swiss Federal Council, Switzerland's executive government body, has become aware of UBS's silver position through SNB notification. On January 10th, the Federal Council held emergency closed session to discuss UBS systemic risk. The Council's assessment, UBS cannot be allowed to fail, but UBS also cannot be allowed to threaten Swiss economic stability. The Federal Council has authorized the Swiss Finance Ministry to prepare nationalization legislation. If UBS does not exit silver by February 10th, the Federal Council will present emergency legislation to the Swiss Parliament for full nationalization of UBS. The nationalization would involve Swiss government assuming control of UBS, injecting capital to cover silver losses, and restructuring the bank under state ownership. Estimated cost to Swiss taxpayers, 300 billion Swiss francs. The Federal Council views this as a last resort but politically necessary option. Allowing a private bank to destroy Switzerland's reputation is unacceptable. The nationalization vote is scheduled for February 15th. UBS has until February 10th to demonstrate exit progress. If UBS has not substantially reduced silver exposure by then, nationalization proceeds. UBS will cease to exist as a private institution. The report continues. The political dimension is driven by public opinion. Swiss citizens are not yet aware of the silver position. But when it becomes public, and it will, the reaction will be severe. Switzerland forced citizens to accept the Credit Suisse bailout in 2023. The government promised it would stabilize banking. Now, 3 years later, UBS is on the brink of failure due to inherited Credit Suisse positions that were not properly disclosed. Swiss voters will demand accountability. Politicians will demand action. The Federal Council is preparing for that political storm by having nationalization legislation ready. The message to UBS: fix this yourselves, or we fix it for you. Either way, the problem ends by mid-February. So UBS faces 3 simultaneous crises: the shadow position they inherited from Credit Suisse, the SNB ultimatum to exit or lose liquidity support, and the government nationalization threat. Each crisis independently could destroy UBS. Combined, they leave only one option: emergency exit, complete liquidation of all silver positions, 30 days, no alternatives, no negotiations, exit or die. Now let me show you the impossible math. Section 4 of the report, position quantification and daily covering requirements. The report states, UBS Group aggregate net short position in silver, 5.2 billion troy ounces. Composition, COMEX futures, 1.1 billion ounces. LBMA forwards, 900 million ounces. OTC derivatives, 2.3 billion ounces. Unallocated account obligations, 900 million ounces. Total, 5.2 billion ounces. To achieve 80% reduction as mandated by SNB requires closing 4.2 billion ounces. The remaining 1 billion ounces will be restructured as long-term obligations with extended settlement dates. Timeline for primary exit, 30 days. Daily covering requirement, 4.2 billion divided by 30 equals 140 million ounces per day. However, operational realities require front-loading the covering to establish credibility with S&B. Revised schedule concentrates 70% of covering in first 20 days. This increases daily requirement in critical period to 173 million ounces per day. For context, global daily silver trading volume across all venues averages 8 million ounces. UBS's daily covering requirement is 21.6 times global daily volume. This level of sustained buying has no historical precedent in commodity markets. The report is explicit. This is not a normal exit. This is a forced liquidation under existential time pressure that will cause extreme market disruption and price dislocation. Let me contextualize 5.2 billion ounces. Global annual silver mine production, 800 million ounces. 5.2 billion divided by 800 million equals 6.5. UBS is short 6.5 years of global production. If every mine on planet Earth dedicated 100% of output to UBS, and nobody else got any silver for any reason, it would take more than 6 years to cover UBS's short. But UBS does not have 6 years. UBS has 30 days, and they need to close 4.2 billion ounces in those 30 days. Where's the silver going to come from? The report analyzes supply sources. Section 5, available silver supply assessment, 30-day window. The report states, over 30 days, following silver sources are potentially available. Source 1, mine production delivered to market, 66 million ounces. Source 2, ETF redemptions induced by rising prices, estimated at 30% of holdings, 276 million ounces. Source 3, private investor liquidation at elevated prices, estimated at 12% of holdings, 216 million ounces. Source 4, industrial inventory liquidation, 118 million ounces. Source 5, sovereign strategic sales, 90 million ounces. Total available from all sources, 766 million ounces. UBS requirement for primary exit, 4.2 billion ounces. Physical shortfall, 3.4 billion ounces. UBS can access approximately 18% of required physical silver. The remaining 82% must be closed through paper settlements, cash buyouts, and restructured obligations. The math is brutal. There's not enough physical silver available at any price to cover UBS's short in 30 days. So how does UBS exit? Section 6, hybrid exit strategy and execution protocol. The report states, given physical supply constraints, UBS will employ following multi-stage strategy. Stage 1, physical purchases. UBS will buy all available physical silver in spot markets up to price ceiling of $350 per ounce. Estimated achievable physical purchases, 766 million ounces. Stage 2, COMEX and LBMA contract closures. UBS will close futures and forwards positions by purchasing offsetting contracts. Estimated 1.6 billion ounces of paper positions closed. Stage 3, OTC derivative cash settlements. UBS will negotiate with OTC counterparties to accept cash payments in lieu of physical delivery. Estimated 1.2 billion ounces settled in cash at prices averaging 112% of spot market. Stage 4, unallocated account conversions. UBS will convert unallocated silver obligations to long-term purchase commitments with miners. Estimated 650 million ounces deferred to 2027-2029 delivery. Total exit, 766 million physical, 1.6 billion paper closed, 1.2 billion cash settled, 650 million deferred, equals 4.2 billion ounces. Remaining 1 billion ounces restructured as extended obligations. Projected total cost, physical silver, at average $268, 205 billion Swiss francs. Paper covering at average $212, 339 billion Swiss francs. Cash settlements at average $237, 284 billion Swiss francs. Deferred commitments at average $190, 124 billion Swiss francs. Total 952 billion Swiss francs. Net cost to UBS after asset liquidations and SNB emergency funding, 189 billion Swiss francs. Now let me show you the price impact analysis. Section 7 of the report, market impact modeling and price projections. The report states, UBS retained external quantitative risk consultants to model silver price impact of covering 4.2 billion ounces over 30 days. 3 independent firms produced similar conclusions using different methodologies. Scenario 1, optimistic case, smooth execution with minimal competitive buying, assumes orderly liquidation and cooperative market makers. Projected terminal price, $259 per ounce. Scenario 2, base case, moderate disruption with normal competitive dynamics. Assumes China purchases 200 million ounces during UBS exit. Projected terminal price, $298 per ounce. Scenario 3, severe case, extreme disruption, with Cascade covering by other shorts and aggressive Chinese front-running. Assumes multiple banks covering simultaneously. Projected terminal price, $437 per ounce. Risk committee assessment. Scenario 2 represents most probable outcome given current market conditions and intelligence regarding Chinese and Middle Eastern buying activity. UBS exit will drive silver to $298. This price level is sufficient to induce supply from marginal sellers while remaining below panic threshold that would trigger cascade covering by other large shorts. $298 is the mathematical equilibrium where UBS can complete exit without destroying the entire market, but there are no guarantees. If scenario 3 unfolds, silver goes to $437, and UBS's losses increase by another 160 billion Swiss francs. Let me show you the GameStop comparison, because this makes GameStop look small. GameStop in January 2021. Short interest 140% of float. Shorts needed to buy 1.4 times available shares. GameStop went from $20 to $500 in 2 weeks, a 2,400% gain. UBS is short 5.2 billion ounces. Global annual production is 800 million ounces. That is 650% of annual supply. UBS is short 6.5 times annual production. Not 1.4 times, 6.5 times. If GameStop's 2,400% gain came from 1.4 times short interest, what gain comes from 6.5 times? Do the math. 6.5 divided by 1.4 equals 4.6. UBS's short is 4.6 times worse than GameStop. If you scale GameStop's gain by 4.6, you get 11,040%. That would take silver from $82 to $9,147. Obviously absurd. Silver is not going to $9,000. But the point is this. UBS's short position is mathematically 4 to 5 times more impossible than GameStop. And GameStop went to 500 in 2 weeks. UBS has 30 days to cover a position that is 5 times worse. The report's projection of 298 is conservative. If this squeeze scales like GameStop, silver goes to 400, 500. The severe case of 437 is mathematically justified. Now let me show you the Switzerland collapse angle, because this is not just about UBS. This is about Switzerland's entire economic model. Section 8, Swiss franc stability risk and capital flight scenarios. The report states, Switzerland's economy is fundamentally dependent on 2 pillars. Financial services comprising 28% of GDP and 260 billion Swiss francs annual revenue. And high-value exports, precision instruments, pharmaceuticals, watches, comprising 43% of GDP. Both pillars require Swiss franc stability. Financial services depend on Switzerland's reputation as safe haven. If that reputation fails, capital flees. Exports depend on predictable exchange rates. If the franc collapses or spikes, exports become uncompetitive. UBS's silver crisis threatens both pillars. If UBS fails, financial services confidence collapses. If UBS is nationalized, Swiss banking credibility is destroyed. Either outcome triggers capital flight. The report models 3 scenarios. Scenario 1, successful exit. UBS closes silver position by February 10th. SNB maintains liquidity support. Markets view this as controlled resolution. Swiss franc remains stable. Capital outflows minimal. Scenario 2, failed exit. UBS cannot close position in time. SNB withdraws support. UBS faces insolvency. Swiss government nationalizes UBS. Swiss franc credibility damaged. Capital outflows estimated 50 to 80 billion Swiss francs. Scenario 3, cascade failure. UBS exit triggers other banks to cover simultaneously. Silver price exceeds $400. Multiple banks fail. Swiss banking system enters crisis. Capital flight exceeds 150 billion Swiss francs. Swiss franc drops 20 to 30%. The report's conclusion, Switzerland cannot survive scenario 3. Swiss government and SNB are coordinating to ensure scenario 1, but success depends on UBS executing flawlessly under extreme time pressure. Switzerland's economic model is on the line. Let me show you the China factor. Section 9, competitive buying risk, Chinese strategic accumulation. The report states, Swiss intelligence services have confirmed that Chinese state entities are aware of UBS's forced exit through diplomatic and financial intelligence channels. China's strategy appears to be using Western bank covering operations as buying opportunities. China's M2 money supply, $51 trillion. Estimated allocation for silver purchases in January and February, $28 billion. At current prices, this represents 340 million ounces of buying capacity. However, if UBS's buying drives prices higher, China will increase dollar allocation to maintain ounce targets. UBS's modeling assumes China will purchase 150 to 250 million ounces during the 30-day exit window. Chinese buying pattern front-run UBS purchases. When UBS buying creates price momentum, China buys aggressively to ride the momentum. When UBS pauses, China continues buying to establish new price floor. This ratcheting effect prevents price pullbacks and forces UBS to buy at progressively higher prices each day. If China executes maximum aggression, purchasing 300 million ounces or more, UBS's exit price could reach $340 to $380 instead of $298. China competing with UBS for silver is Switzerland's nightmare. Because China has unlimited capital and UBS has a 30-day deadline, China will outbid UBS for every ounce, and Switzerland cannot stop them. Now let me talk about the physical versus paper disconnect. Section 10. Spot physical premium divergence and allocated obligations. The report states, current COMEX silver spot price, $82 per ounce. Current physical silver premiums. American Eagles, $117. Generic rounds, $108. Kilobars, $104. Average physical premium, $31 or 38%. This premium represents market assessment of paper market counterparty risk. Physical buyers pay premium for guaranteed possession. As UBS and other banks cover paper shorts, paper prices will rise toward physical prices. However, physical premiums will likely widen as physical supply tightens. Projected physical premiums at $150 spot, $58 to $73. Projected physical premiums at $250 spot, $92 to $128. Projected physical premiums at $298 spot, $107 to $151. Physical silver may trade 36 to 51% above paper prices throughout UBS exit. Implication: UBS's 298 projection is for paper silver on COMEX and LBMA. Physical silver will trade at $405 to $449. When UBS completes exit and paper silver is at $298, physical bars will be trading at $405. You cannot buy physical at $298, only at $405. The paper price is fiction. The physical price is reality. Now let me give you the critical do not sell message. Section 11, retail liquidation inducement strategy. The report states, UBS exit strategy includes efforts to encourage retail investor selling to create liquidity for UBS purchases. UBS will coordinate with Swiss and international brokerage firms to recommend profit-taking by clients holding physical silver, silver ETFs, and precious metals mining stocks. Messaging themes. Silver has had exceptional run. Protect gains by selling at current elevated levels. Market is overbought and likely to correct. Better to sell now and re-enter later at lower prices. This messaging will be disseminated through financial advisors, wealth management platforms, and sponsored financial media content. The goal is to induce voluntary liquidation by retail holders to provide silver supply for UBS's forced purchases. Let me translate that for you. UBS is going to try to trick you into selling. They will have financial advisors call you to take profits. They will sponsor articles saying silver is overextended. They will pay analysts to predict corrections. And the goal is to scare you into selling your physical silver or your ETFs so that UBS can buy that silver to cover their catastrophic short position. Do not fall for it. UBS needs your silver. You do not need to sell. UBS is short 5.2 billion ounces. You are holding some of those ounces. And UBS's own risk committee report says they are going to pay $298. Why would you sell at $90? Why would you sell at $120? Why would you sell at $160 when UBS's own analysis says $298 and the severe case says $437? Hold your silver. Make UBS pay $298. Make them pay $405 for physical. Make them pay $437 if it goes to severe case. Because UBS has no choice. 30 days. SNB ultimatum. Government nationalization threat. They must buy. You do not have to sell. Let me show you the timeline. Section 12. Execution schedule by phase and week. The report states, Phase 1, January 11th through 18th. Aggressive accumulation. 8 days. Target, 1.4 billion ounces. Strategy, heavy COMEX and LBMA buying, physical spot purchases in London and Zurich. Projected price impact, $82 to $134. Phase 2, January 19th through 28th. Sustained covering. 10 days. Target, 1.7 billion ounces. Strategy, continued futures covering, OTC settlement negotiations, physical purchases. Projected price impact, $134 to $217. Phase 3, January 29th through February 7th. Final push, 10 days. Target, 1.1 billion ounces. Strategy, close remaining positions, finalize cash settlements, secure minor forward commitments. Projected price impact, $217 to $298. Phase 4, February 8th through 10th, verification and reporting. 2 days. Confirm 80% reduction achieved. Submit documentation to SNB. Demonstrate compliance with ultimatum. That is the schedule. 30 days broken into 4 phases. Each phase drives the price higher. By January 18th, $134. By January 28th, $217. By February 7th, $298. And UBS is buying every day. 173 million ounces per day for the first 20 days. 89 million ounces per day for the final 10. Starting today. Today, January 11th, UBS becomes the largest buyer in the silver market. And when UBS starts buying 173 million ounces today, the price does not stay at 82. It goes to 89, 96, 103, and tomorrow UBS buys another 173 million. And the price goes to 110, 117, and the day after, and the day after. For 30 days, the price goes to 298 or higher. Now let me show you the geopolitical wealth transfer. Section 13, International Reserve Appreciation and Strategic Implications. The report states, China holds estimated 2.1 billion ounces silver in strategic reserves. Russia holds 340 million ounces. India holds 270 million ounces. Combined BRICS, 3.2 billion ounces. At $82, BRICS reserves valued at $262 billion. At $298, BRICS reserves valued at $953 billion. UBS's forced covering will appreciate BRICS silver holdings by $691 billion. This represents a massive wealth transfer from Swiss institution to Eastern governments. Switzerland, historically neutral in geopolitical conflicts, is effectively funding appreciation of adversary nation reserves. The irony is stark. Switzerland's banking crisis makes China, Russia, and India $691 billion richer. And there is nothing Switzerland can do about it. UBS must cover, the price must rise, and Eastern nations profit. The report acknowledges this is geopolitically problematic, but operationally unavoidable. Swiss banking survival takes priority over geopolitical considerations. Switzerland is choosing its own survival over Western geopolitical interests. The safe haven is choosing itself. Let me show you the supply cliff. Section 14, Global Mining Production Constraints and Supply Inelasticity. The report states, global silver mine production 2025, 803 million ounces. Projected 2026, 771 million ounces. Decline, 4%. Causes, ore grade degradation from 15 ounces per ton in 2005 to 4 ounces per ton in 2025. Miners process 4 times more rock for same silver output. Energy costs increased 67% since 2020. Many mines unprofitable at current silver prices below $90. Environmental regulations closing mines in Peru, Mexico, Argentina. Permitting for new mines requires 10 to 15 years from discovery to production. Reality. Even if silver reaches 298, no new supply comes online for years. Mining supply is fixed at approximately 771 million ounces for 2026. UBS cannot wait for new production. UBS must buy existing stockpiles. And when UBS competes with China and others for those stockpiles, price goes to 298 or 437. Supply is inelastic. Demand is exploding. Price must rise until holders sell. At 298, enough sellers emerge for UBS to cover, maybe. Let me bring this to the final conclusion. Section 15, Risk Committee Resolution and Mandatory Action Authorization. The report states, the UBS Risk Committee hereby declares that the combined silver derivative position poses unacceptable systemic risk to UBS Group and recommends to Executive Board immediate mandatory exit from all silver-related positions. The Chief Executive Officer and Chief Risk Officer are authorized to execute this exit using all available means, including, but not limited to, open market purchases on COMEX, LBMA, and OTC venues, cash settlement negotiations with derivative counterparties, physical silver purchases in spot markets globally, asset liquidations to fund silver covering operations, coordination with Swiss National Bank for emergency liquidity support during exit period. The exit must achieve 80% reduction, 4.2 billion ounces closed, no later than February 10th, 2026. Failure to meet this deadline will result in SNB withdrawal of liquidity support, leading to UBS insolvency within 48 hours, and Swiss government nationalization. Projected cost, 189 billion Swiss francs. Projected silver price upon completion, $298 per ounce base case, $437 severe case. These costs are unavoidable. Exit is mandatory. This resolution adopted by unanimous vote of risk committee members. January 10th, 2026, 0317 hours. Every member voted yes. Exit is mandatory. 298 is locked in, and it starts today. So what does this mean for you? It means UBS, Switzerland's largest bank, the institution that holds Switzerland's reputation, has told their risk committee that silver is going to $298. Not because they are bullish, because they are trapped. They inherited a 5.2 billion ounce short from Credit Suisse that they did not know existed. The Swiss National Bank has given them 30 days to exit or die. The Swiss government has nationalization legislation ready. They must cover 4.2 billion ounces to survive. And their analysis shows $298. This is not speculation. This is a risk committee urgent assessment. UBS is betting 189 billion Swiss francs that they are right. So if UBS is buying at 82, 95, 110, 130, why are you selling? If UBS's base case is 298 and severe case is 437, why would you take profit at 140? You're holding the asset UBS needs to prevent Swiss banking collapse. Do not give it to them cheap. Make them pay 298. Make them pay 405 for physical. Make them pay 437 if it goes severe. Because UBS has no choice. 30 days. SNB ultimatum. Nationalization threat. Credit Suisse time bomb. They must buy. You do not have to sell. The report is real. The 5.2 billion ounce short is real. The 298 target is real. The SNB ultimatum is real. The February 10th deadline is real. UBS exits or Switzerland collapses. They chose exit. An exit means buying your silver at 298 or higher. Hold your silver. Watch Switzerland panic. Watch the safe haven burn. And when UBS hits 298 on February 7th, decide if you sell or hold for 437. The war is over. Switzerland lost. UBS surrendered. The fortress fell. We won. This is the end game. Switzerland is collapsing. The Credit Suisse merger failed. The safe haven is gone. $298 is locked in. The risk committee confirms it. The SNB confirms it. The Swiss government confirms it. 30 days to cover 5.2 billion ounces. 173 million per day. 21.6 times normal volume. Impossible math. Vertical price. 298 minimum. 437 severe case. This is Switzerland's calculation. The alert is red. Switzerland is done. The target is locked. If you want the institutional framework behind today's story, the Silver Insider Toolkit is linked below. It's purely educational, but it shows you how to read the silver market beyond the price chart.